Welcome to This Week in Money. I'm Jim Goddard. Today, Victor Adair runs down the major markets. He points out many markets around the world have seen record highs so far this year, but the big question is, will the bullish sentiment continue after Labor Day? Victor examines crude, gold, the U.S. and Canadian dollars. He also tells us that the euro has been red hot the last few months, and he answers the question, is this a good time to load up on commodities? Editor of Rick's Picks, Rick Ackerman, takes a look at the new world under President Trump's tariffs, the unfulfilled promises of AI so far, the health of the gold market, and whether the stock markets will continue to climb higher. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, joins us from San Diego to talk about what's happening with U.S. real estate in general and also in California. He gives us his thoughts on gold and interest rates. Bob also has some important health tips for you. We'll talk to Victor Adair right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very, very active in the markets. His website, victoradair.ca. He's speaking to us from Parksville on beautiful Vancouver Island. Welcome back to This Week in Money.
Jim, it's always a pleasure to visit with you. Thank you.
Victor, can you give us a quick overview of what's happening on the stock markets right now?
Well, let's say it this way. Virtually everything that matters in terms of stock indices around the world is at or near all-time record highs. We, of course, had that dip back in April. It was quite a dip, actually, maybe even a mini crash in some people's point of view. But anyway, we were down in April when Trump unveiled the Liberation Day tariffs that he was going to put to the rest of the world. But since then, okay, it's been nothing but up. The world benchmark, the S&P 500, is up about 35%. It was up at new highs again this week. The NASDAQ up about 45%. In Toronto, 27%. The Dow up 25%. If you look at the European version of the Dow, we call it the Euro Stoxx 50 index. It's up about 23%. In the UK, the FTSE. That's the Financial Times special index, up about 23%. And one of the hottest ones in the world, unbeknownst to most of us, over in Japan, the Nikkei index, since April, up about 38%. Now, those are, honestly, I mean, taking the market to all-time highs, with these very sharp gains since the April lows. There's been a very steep rally. It seems, a lot of the metrics where you say, what the share price is in terms of sales or earnings or that sort of thing, are richly priced. The prices are obviously at all-time highs. They're expensive. So there's some folks, and, I read a hell of a range of people to get different opinions. Some folks certainly think the market's overvalued here, and due for a crash. There's always the doom squad out there. And other, it seems, equally bright folks think, you can't afford to try to poke this market in the eye. You can't afford to short it, in other words. So it's just on a roll, and it's going to keep going. That's the TINA crowd. There is no alternative. And, of course, there we have the FOMO people. They're at fear of missing out. They see this thing going up. They hear their friends are making money. Certainly, the market seemed to be embracing risk with enthusiasm. It's not like everybody's going out and just buying shares of the Royal Bank of Canada. They're buying shares in things that God knows what those companies are doing, and certainly they're not making any profit. So the mood overall is buoyant. Actually, that reminds me, one of the fellows that I subscribed to, a veteran from the New York floors years ago, had a great line in his commentary the other day. He said that the mood of the market is more important than earnings. And to the old Ben Graham kind of value investor sort of people would just curl their toes hearing something like that. But I think, honestly, Jim, that is kind of where the stock market's at right now. The mood, the bullish mood, is more important than old school stuff like earnings.
What's going on with gold?
Well, I think the eye-catching thing on gold happened about a week ago when someone working in the United States in the Department of Borders and Customs or whatever decided, reading whatever he read, that the imports of gold, particularly from Switzerland exports more gold than anybody else. They're sort of the world's leading refiner of gold. Anyway, gold coming into the United States from Switzerland would be tariffed at 39%. Well, this was a hell of a shock to the gold market and for people in it. I think very quickly a lot of folks, kind of like me, thought, okay, this is going to be like a reprise of what happened to copper in July, where the beginning of July, I suppose July the 8th or so, the market was led to believe that copper of all kinds would be tariffed. And then 3 weeks later, the White House came out and said, "Oh, no, not just stuff that's made out of copper, bars of copper, refined copper, that can come in without a tariff." It was like an oversight, but a multi-million-dollar oversight. Same thing happened in gold. A couple of days later, after the person, the bureaucrat in the government had made this determination, it was overturned by the White House. So, gold, as everybody knows, we had a real run-up in April to all-time highs, just short of $3,500. It's basically gone sideways in about a $200 range since then, just up and down, no big increases in volume or open interest or anything like that. So it's kind of, I think one of the things that's happening with gold is that the amount of central bank buying has diminished from the real run-up that we had that spurred a good part of the earlier rally. So I think we wrapped up the week at about $3,380. That's basis December futures. That's what I trade. I don't trade the spot market, so I can't give you any hard number on that. But overall, the gold market had a run for the roses, hit all-time highs in April, and we've been going broadly sideways since then.
What's going on with the U.S. and Canadian dollars?
The U.S. dollar, let's put it this way, the trade-weighted index of the U.S. dollar hit an all-time high in January of this year. Trade-weighted means just what you would think it means, how much volume you're doing with Germany or Japan or China or India or whatever. And that was obviously a milestone for the dollar to be that strong. We have another index, we call it the Dixie, which is heavily weighted to the euro. It was at about 2-year highs, and the reason the trade-weighted one was so much higher was because it had a heavy weight of Asian currencies in there. Whatever, let's get to the big picture here. The U.S. dollar was near all-time highs as we got into the beginning of this year. Clearly the American administration, or parts of it, was saying that they would like to see the dollar lower, that foreigners who had been artificially keeping their currencies down so that they could ship stuff to the United States, mercantilist policies, were cheating. They had needed to get their currencies higher. Anyway, we've seen the U.S. dollar generally weaken from high levels this year, and the last 2 months or so going broadly sideways. Now, that's a real big picture. There's a lot of things under the hood, but maybe we can come back to that. The Canadian dollar, we had a 20-year low back in February at 68 cents, thereabouts. It's rallied from there, as all currencies have rallied against the U.S. dollar this year. For the past 2 to 3 months, I guess, we've been, again, like gold, in a sideways range between 72 and 74 cents. The market right now is expecting the Bank of Canada to cut interest rates by 25 basis points sometime between now and the end of the year. So, yeah, it's been a bit dull in the summertime here in the currency markets. I think maybe things will get a little more volatile as we get into the fall.
What's happening with other currencies?
Well, I think you got to start with the euro. The euro and the U.S. dollar are the two major currencies in the world, and you could say it this way. I think on the futures market, almost 50% of the open interest in all currencies is in the euro, so it's that much more important than everything else put together. The euro is up about 15% from where it was in January. The currency, I suppose, that surprises me is the yen. And the yen is at virtually an all-time low against the euro. And I've mentioned earlier about the Asian currencies having these mercantilist policies where they've kept their currencies low. Well, the yen is like the benchmark. All the other countries in Asia effectively have kind of got to keep their currencies in line with Japan because they all are competing with each other to get into the Western markets, particularly the United States. The yen has not been as strong as I think the market would have expected, which is one of the reasons why it's weakening against the euro. I'm thinking at some point, the Americans may directly pressure the Japanese to revalue their currency higher. Just this few days ago, the Treasury Secretary urged, and that's a polite term, the Bank of Japan to raise their interest rates some more. And if, in fact, they were to do that, that might help the yen to get a little higher. So, yeah, that's the one that surprises me in terms of the market action. Another currency that I've traded a lot over the past couple of years is Mexican peso. One of the features of the peso has been that their interest rates are usually way higher than anywhere else. So there was let's call it a multi-billion-dollar game going on where people would borrow money in Japanese yen because interest rates were practically zero and reinvest the money in Mexican pesos and make it a hell of a spread. Now, that trade worked like a hot damn until summer of last year when they had a change of government. But even so, the Mexican peso has come back about 15% here so far this year when it was at risk, say, of maybe getting knocked down because of the negotiations between Trump and Mexico on tariffs.
What's going on the crude market?
Crude had a spike up to, let's call it $78 when things were heating up between Iran and Israel. I mean, you could think back over the past few years. The market, we had these geopolitical issues in the Middle East, but like the granddaddy of them all would be what's going to happen if Iran and Israel go head-to-head. Well, they did, and what would they call it, the 5-day war or something like that. But during that period of time, there was a premium in the WTI price in crude everywhere, but essentially that's the one we're looking at, where, what happens if they shut the Strait of Hormuz, or what happens if Iran, trying to get even, hits some of the facilities in Saudi, for instance, or Kuwait. Anyway, that was a short-lived thing, and since then, the crude market has slid down. We traded $62 or so on the front-month futures this week. Crude has been a market where there's actual supply and demand of a commodity, unlike the financial markets. I think the theme here has been OPEC is increasing production. They want to get paid. They want to get market share. And demand isn't surging, so when you got more supply than demand, prices tend lower. So as I say, down around $62 or so this week on front-month WTI.
Some analysts have been pointing out that commodities generally are very cheap compared to stocks, and this might be a good time to load up on them. Do you agree?
Short answer, no. That's what I would call a relative value trade, and believe me, I've seen the charts, and the people that really want you to get in the commodities market can generate these charts and make them very effective. Commodities are cheap, but over time, commodities are like commodity prices anywhere are maybe the victim of technology. As technology improves and the ability to source or grow commodities improves because of improvements in technology, the prices just continue to go down. And at the other side, stock seems to be like, running on high-octane fuel, running away with with a very, very pricey valuation. So, yeah, maybe that gap ought to close. To me, it's more a thought for as a trader. Okay, that's more like thinking about something you could talk about at a cocktail party rather than a trade that I would actually put on. I mean, take a look at copper here, and copper has been a wonderful example of this. The electrification of everything has been a topic going back over the last 10 years, as people started to drive electric cars and the demand for the grid and the AI and data centers and on and on and on. There was just the narrative basically was there was going to be such a demand for copper that no way in the world would miners be able to find enough of it or recycle enough of it or what. And yet, despite that, the price wasn't running away to the stars. We've got up to around $5 a pound for copper in the New York markets anyway. And I think one of the overlooked things there was that as recently as the last 2 years or so, 50% of the global demand for copper has been China. And like they're using it in growing their economy, their manufacturing base, whatever. And China has been slowing. And that right there, it seemed, was maybe part of the answer for why isn't copper at $15 a pound, that sort of thing. And then, of course, we had that that mistake in copper where they thought there was going to be tariffs on it. The price was spiked up, and people probably then jumped at it, got into it, and then there was a correction. Oh, no, we're not going to have a tariff on it. And people who had maybe bought into the new high price of copper just got their clocks cleaned. I mean, copper just tumbled, I don't know, it was 15 or 20% in a heartbeat when they corrected the tariff. So, yeah, copper's been a struggle. Let me give you another example. Wheat. There's pretty basic stuff, wheat. They make bread out of it, that sort of thing. I mean, the price of wheat went to, I'm going to say it was all-time highs, but if it wasn't, awfully close. Call it $13 a bushel just after the Russians invaded the Ukraine. The Ukraine, everybody would know the term breadbasket of Europe. Okay, the price of wheat now is about $5. So it's down 65% from the all-time highs. And I remember in March of 22 on my weekly trading desk notes, I had snipped out and put a picture of the cover of the Economist magazine, basically saying, wheat is going to the moon, we're all going to starve to death because there's not enough of it, and so on. The technology, I'm going to repeat this, that is out there to source and grow and whatnot, different commodities has been a constant deflationary force for a long time. So, no, I don't think it's a great idea to dump your stocks and put your money into commodities. I think you have to be aware that that's out there, but it's not the top trade on my list.
It's the middle of August. There must be a lot of traders taking their vacation right now. So, what do you think's going to happen come September?
I can be a little dramatic here. I think when they ring the opening bell after Labor Day, we're going to find ourselves, market-wise anyway, in a much different world than we've been having lately. I was saying, the stocks are making new highs and that, but volatility across markets is low. Now, I'm just haven't done this for 50 years. You find that markets, it's the pendulum, and it'll go from, one extreme to the other and swing through. And I think we're at a relative extreme here in terms of how much risk people are willing to take or are taking or feel as though they have to or they're going to get left behind, that kind of thing. I'm trying to find in my mind here a cliche. Oh, here's one. Okay, the old order is changing. I think there's some of that in the world, that Trump and Putin getting together, and the White House has kind of downplayed, this meeting. Like, don't expect too much from this. They're just kind of getting to know each other. Haven't seen each other for some time. But, we've just had this hegemony from America. I don't know, maybe it goes back 25 years. I was just listening to Jeffrey Sachs the other day and really kind of waking me up. And he, by the way, talks a lot like Martin Armstrong does. And I know you have Marty on frequently where Marty has a view on what he calls the neocons and NATO and that, and these folks think of America as they're in charge of the world, and whatever they say is what should happen. And certainly Donald Trump, God bless him, seems to be a bit of a poster child for that, although I think he's not exactly in bed with neocons, and Marty Armstrong would certainly point that out. But anyway, let's come to this. American exceptionalism has been a very powerful force in the financial markets for the last 20, 30 years. And one of my expressions, you've heard me use it on the show, capital comes to America for safety and for opportunity. And it's like there's safety and opportunity in America that there isn't elsewhere. But again, to go back to my friend JJ, who was talking about the mood of the markets these days is more important than earnings. Well, I think one of the key numbers we're going to see at the beginning of September will be the employment report. And that's going to have a bearing on what happens to interest rates. If we get another soft employment report, or softer than expected, like we just had here a week ago, that's going to change the mood a lot. And if we start to see some of these markets correct from the highs that they've been at, that correction could be substantial. So volatility would ramp up. Just to get back to where I started, when that opening bell happens to start off the trading in September, don't expect the markets to just be kind of drifting sideways. I think we're going to get some action.
Victor, thank you so much for chatting with us.
Well, Jim, it's always fun. Thank you. I maybe rambled there a bit, I suppose, but it's summertime. It's a good time to ramble.
My guest has been Victor Adair. His website, victoradair.ca. He was speaking to us from Parksville on Vancouver Island. Coming up, Rick Ackerman, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Today, he's speaking to us from...
Well, I'm back in sunny Florida, Jim, after a 2-month road trip, and I'll tell you, I'm going to get the hell out of here as fast as I can. It's even the people I know here who say, "Oh no, you get used to the hot weather. I love it." Well, they're not loving it this summer. It's just hotter than hell.
How would you rate the Trump administration so far in its handling of the economy and its plans for the economy?
I think it's a lot of show, really. Trump has some enormous successes there in, let's say, the socio-political sphere. In one area of it, we could actually see the indictment of a former president, namely Obama, and if Hillary gets her just dessert, she'll wind up in prison. And it's interesting because the charge of treason here is not really reaching too far. If some of the things that have been reported, Obama's meeting with Comey and the boys to say, no, I don't like the story that Russia did not interfere with the election. You need to come back with a better story that they absolutely did interfere. So all the big guys at the NSA and the FBI and the CIA changed the narrative entirely, mainly to help get rid of Trump. I mean, it was kind of an ongoing coup, and yeah, that's treason. So we have a genuine charge there that may stick, and apparently there are a few grand juries coming at it from different directions. So Trump has achieved enormous success. He's also crushed the breath out of woke, and he's just sort of finally let a lot of people who want to live normal lives come out of the closet. So in the area of kind of changing the cultural milieu, Trump has had enormous success. But if you look at economics, there's no expert on earth who can really say what the tariff changes are going to do. I kind of favor David Stockman's take, which is that if capitalism is working correctly, if it's free to work properly, then you really don't need a deal maker in the White House. So Trump has made all these deals, but ultimately for what? So we get to collect taxes from other countries that want to do business with us in the form of tariffs. But is that good? For sure, Trump has followed his campaign promise of putting America first. We're always thinking about America, and he certainly sliced and diced his European negotiating. I won't even call them partners. They were not even in the game, and Europe kind of rolled over for 20% tariffs across the board. And you can see just how Trump. You can see the art of the deal right there, because most countries were offered a deal of around 25%. So they thought, well, we're coming out better with 20% tariffs. And a couple laggards who didn't grab 15% when they had it are probably regretting it. But all right, so Trump negotiated deals with these European countries, but I think it's not stretching a task. So what? Over time, yes, it will, I guess, reorganize the way trade is conducted globally. But who the heck can predict really whether the changes will be favorable? And one other thing to be said that is kind of aligned with what David Stockman said is that the tariffs may have been unfair. They may have looked unfair when you saw the sums that were involved, how much, in dollar terms, certain exports were protected by our trading partners. But you could also say that with all those tariffs in place, the system still found equilibrium, so that you could make the argument that nothing needed to be changed in the way of tariffs because the system was working. However, it was messy, but it worked. And if you're going to justify what Trump did, it would be purely on the basis, and this is not a bad thing, that the United States reap additional benefits. But longer term, it's hard to say really whether we actually will. So Trump's doing great there, and I think even his ideas about reshoring manufacturing are good. We have to start somewhere, and we can't bring the production of certain things back to this country without incurring a cost in the interim. So that could take years. So I think he's on the right track there. But let's say the stock market has gotten quite a bit ahead of any possible results that could come of it. So anyway, it's a mixed picture, but the stock market is certainly on the hubristic side of it, flying high on some potent narcotic here, and it can't keep going up forever.
How would you rate what's happening in the stock market? How long can this enthusiasm last?
Stock market has been on drugs for 16 years. It's you can't really put a top on it because I've explained this in enormous detail in my newsletter, how the stock market creates literally trillions of dollars of phony wealth with gap openings in these mega stocks. On a stock like Apple, on 3 consecutive days, gaps higher. Over those 3 days, Apple added something like $500 billion worth of phony wealth, and the gaps are technically places where stock didn't even change hands. In other words, it took no capital, it took no bullish buying to push these stocks 20 or 30 points higher. They simply closed at one price, Apple at $202 a share, and before you know it, with no stock having changed hands, it's up there close to 230, and that's a lot of bucks. And it's a given that the stock will come down just as hard in a bear market as it has gone up. There's going to be these air pockets in the shares of not just Apple, but Nvidia, Microsoft, and all the others. And I say Nvidia. Nvidia is probably the best of the bunch. It has the most. It's got just an amazing prospectus, because it's selling chips valued at $100,000 or more by the tens of thousands to guys like Musk. But even so, that stock has had huge gaps all over the chart, and the gaps are going to be there when things start coming down.
Do you have any idea when that pressure point will hit?
Yeah, 6 minutes from now. I don't, nobody knows really. And, my failure of the imagination to see how crazy things could get started in the 1970s. So yeah, I've been pretty bearish for a while, 40 some years, but it's, when it costs no money to move stocks significantly higher, it's really hard to predict the end of it, especially when the firms themselves are buyers of their own shares, both on the way up and on the way down. They buy on weakness. They buy all the time. So with that and the flow of money into pension plans, you could almost say, well, there will never be a bear market. How could there be? But there will be.
Is there any way to protect yourself from an expected major correction?
Yeah, you just put your money where nobody wants to put it. And bonds have been just that for so long that I guess you got to be in long-term treasuries, 10-year notes and 30-year bonds. And I guess utility companies that have paid a steady dividend are probably a good buy, good defense. Not that there are a lot of defensive stocks, but I'd recommend shares in companies that have paid a good dividend for a long time. But don't buy for the dividend alone, because if you're getting a 2% dividend on a stock and it falls 30% in a bear market, or 40 or 60%, who cares about the dividend? But I think you gotta like Treasury paper here, because there's so many reasons, so many arguments you can make against it.
Do you think we'll get any sizable hint that, oh my God, here we go, we're going into the red? Or it's just going to happen and we don't know why?
Well, how do we know it didn't start yesterday?
Right.
Or last week? I mean, I've got two stocks. You really don't have to get the market right. You just get a couple of the leaders right. In this case, just look at Microsoft. Microsoft is the bull market is over for Microsoft, and the bull market for the stock market is over. So the most recent move in Microsoft, it took the stock. There was a huge gap there on the 31st of July, up to 555. Now it had closed the previous day at around 510. So it made this giant jump, and it came down really hard that day and the next day. And since then, it looks like kind of a consolidation, but maybe not. I look at all my analysis sees stocks in A, B, C, D patterns. And the key sign of a weakening trend is a failure at the midpoint of the CD leg. So in the case of Microsoft, that's 525.92. The recent high, the rally went almost to that, within a few pennies of it. So I could make a case that that Microsoft is on the way down now, and it's possible that the high that we saw on July 31st was the top for Microsoft. So in practice, it's possible to short those highs because they always correspond, at least from my standpoint, with what I call hidden pivot targets. So anyway, I'm always looking for the top, but I'm ready to make a little money if I'm wrong. If you have a target, you want to be long up to that target. You want to get short at the target, and when it pulls back a little bit, you take a partial profit. So you can make money as a bull or bear with the market moving in either direction. And you don't have to sacrifice anything to say, well, I think I'd like to be short Microsoft here. If you were, you got a nice profit. It's more than $30 off the high. So anyway, you just look at a couple stocks and you'll never go far wrong. NVIDIA has been less freakish, NVIDIA's high. This is post-split. I think the last split was 10-for-1. NVIDIA's up, not too far off a recent high at 184 and change. So it's just about $5 or $6 lower now. So you look at a couple stocks and you'll never go far wrong.
AI, is it a sure investment?
No. Well, I mean, it is sure now because nobody who's invested in it has made a dime. So yeah, it's a pretty much surefire way to lose. There are probably less risky ways to lose money, like drilling oil wells in YMCA basements. But for the time being, investing in AI, other than in NVIDIA, the maker of the AI hardware, it's been a pretty surefire bet to lose money. Well, short, medium, intermediate, long term, whatever. There's so many trillions of dollars sunk into AI right now that it's predictable that there are going to be a lot of losers. I don't see where the profits are in AI. I'm more impressed than I used to be with the things that AI can do analytically, and it writes reasonably well. So, but wherever it does something well, you can see it's just going to eliminate some white-collar job. It's in the process right now of eliminating every creative person in the music business. A lot of buyers of what you call stock music can now buy really cheap off the rack some application that will allow them to just make their own music. And I mean, from soup to nuts. They can do the lyrics, the melody, the instrumentation. They can essentially put together a synthesized band to play music that AI has written, the melody and the lyrics. So, it's one thing to be able to tell the difference between an AI wrought poem or work of art. But music is mostly garbage. And it's like, who can tell the difference? If you're in a restaurant or an elevator, whatever, and there's some girl band in the background making you bleed from the ears, it's not, there's no fine shades of discrimination where you can say, oh, well, that's really good music or that's lousy music. Most of it is lousy, and AI is going to be doing it all. And, in the movies, you can see Disney's always going to be in the vanguard of companies that produce absolute crap and sell it in theaters, or the theater industry is dead, but they'll stream it to you somehow. But all creative jobs are really, they're just going by the wayside right now. Every person with a job, that creates something is in jeopardy of losing his job. So, And it's not difficult to extrapolate this process of attrition into other areas of the economy. There's no lawyer who could outperform AI where legal boilerplate, churning out legal boilerplate is concerned. But even in a courtroom, if you put a black box, an AI box in the middle of the courtroom, it technically has access to every single law, every decision, every legal decision that's happened since the founding of the Republic. So it's got the whole the law library in its digital head. And of course, it can argue chapter and verse against any other attorney. So we've felt the initial shockwaves of that because the law school graduating class of 2025, they're just not getting those entry-level jobs because AI is already doing them. So to come back to my original thought, where are the profits in AI if the one thing that it does best is put people out of jobs?
In British Columbia, a lawyer used AI to compile the precedents for her case. AI made up 3 of them, and the judge was pretty close to, not just tossing the case, but having her disbarred for doing that because it was making up cases. Would that be a danger where it's just making up precedents?
Well, the judge can take a hard line on it. He's certainly got an incentive to be insulted, to act insulted, and to go after AI in the courtroom with everything he's got. But, this is something that's going to happen all over the United States and be tested in front of many judges who are not so quick to realize that AI has scripted its own legal precedents for some case. So slowly but surely, AI is going to make inroads, and it's going to put a lot of lawyers out of work. But like pretty much everything else, every other area where people get put out of work, who's going to know the difference? We're living. I mean, I can't think of a way that AI is really. I can't think of a way AI is going to improve our lives unless it's in the area of healthcare. But even then, it may come up with better ways. You'll be able to make certain tissue. You could build whole organs from live tissue using a 3D printer and cellular ingredients. So maybe AI could make a contribution in healthcare, but even there, let's say it goes up against cancer, it's going to take some variation on the approach of, let's say, the Texas Medical Center, a giant mega center of cancer treatment. And instead of treating the cause, it'll treat the symptoms. I don't know how AI is going to bring us around to the proper diet and lifestyle that in itself would be that's the cure for cancer. The cancer really, the cure lies within our stem cell system, our immune system. And of course, you are what you eat. So AI might take a superficial approach in dealing with cancer and have some success, but let's just say not much success. So I'm really down on AI, and I just think much too much is made of this prospect that it's going to make everybody's lives better. If they could make even I don't know. You know that no companies answer their phones anymore. They don't like to interface human help, which costs money, with customers. So they're all virtually the best companies like Logitech, Bose. Well, Bose is still going strong, but even the companies that have talked to their customers are slowly but surely making it much more difficult to get hold of them. And you know yourself that 9 out of 10 of your tech calls, if they send you to an FAQ or some sort of online solution, the solution never works. And you know, most of the time you really do need to talk to a human. So AI is a step away from that, and telemedicine another step away. You know, you shouldn't be able to get face to face with the doctor. We just don't have the resources for that. So let's do a teleconference, and the doctor, without even seeing you, other than on a video screen, will purport to diagnose you. So, boy, am I down on AI. I could just keep going and going.
Well, do you see a day when there might have to be a tax put on companies using AI that replaced workers? Because what's going to look after those humans?
We've talked about that before. That was, I don't know if the idea was original with Bill Gates, but he was obviously, he was the most highly visible proponent of that idea, you know, that we should tax robots. And I have to say, even though I have no, Gates should be public enemy number one. He's probably the person that we should least trust in the pantheon of zillionaires. So, but I think that's a good idea that it's not going to save us. It's not going to somehow preserve the economy, but in a very logical way, it's one way of getting at the problem of robots putting people out of work. And when I say robots, I extend that to the digital outputs of AI. So, and even if the idea has very compelling logic, you can imagine how difficult politically it would be to implement it. The idea that we should start taxing robots. Think of that goes right up against Trump's effort to reshore manufacturing in the U.S. Because if we're really reshoring the manufacturing of the future, that's not going to have a human component. You know, in theory, if you've got AI running the show, you can run a whole auto plant with 3 employees. And of course, McDonald's has already figured out how to do that. They don't do it so well, but when you go in, there's the kiosk, and you can run a McDonald's that has a drive-through and the kind of minimal in restaurant serving space, you know, table space. You can run a whole operation there with just 3 people. So McDonald's has already figured it out. That's their solution for $20 an hour minimum wage. But, of course, at the manufacturing level, because the cost of retooling, especially for auto manufacture, is so high, it's going to take a long time to bring these ideas into play. But nobody sort of thinks through the full consequence of it, and that is, if we're bringing manufacturing back, it's not going to be a labor-intensive kind of manufacturing. The opposite will be true.
Is gold going to protect people if the market has a downturn and values start to drop?
Yeah, gold's done pretty well for thousands of years, so it's a good bet to hold its purchasing power in any kind of economic dislocation, even the one we're looking at. Just to be a little more helpful for your listeners, October gold, COMEX gold, is currently trading 3358.80, and I think it's going to be a buy $41 at 3,317.70. That's where I think it's going to turn. Gold has been screwing the pooch since April, just doing nothing, but it's very much in a bull market. It just happens to be in a holding pattern that stretches back quite a ways. So if you're interested in accumulating gold, just remember that number 3317.70 in the October COMEX contract. So, and be sure if some idiot out there wants to trade you gold for Bitcoin, be sure to give up as much Bitcoin as you can get your hands on in exchange for gold.
What's your outlook for Bitcoin?
It's a fraud, and that hasn't stopped me from forecasting higher prices the entire way up, and we still have an unfulfilled target up around 142,000. So I'm a bull when I look at a Bitcoin chart. But the only problem I have with Bitcoin is when you ask even some supposed world-class expert why Bitcoin should have any value, when they give you the bullet points of why, the bullet points are scarcity, 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 and scarcity. And to me, that's not money. I would have taken Bitcoin myself in payment for my newsletter as an early adopter of Bitcoin had advised me, but it didn't make sense to me because I didn't want to deal in cash receipts that had a capital gains component to them. And even now, we haven't really... Trump will be the last guy to sort of slow down Bitcoin mania by saying, "Hey, it's not really money, or if it is money, we have to sock you with a capital gains tax if you make money on your money." So that's a complication that I wasn't willing to deal with back then. And the people who said, "Well, screw it, they're never gonna sock us with a capital gains tax anyway," they wound up making out just fine. But it's still, I guess, an unsettled question of how you affect transactions in money where there's a capital gains component. You get around that with a stable coin, I suppose. But even then, I think it's probably a complicated tax issue if you want to go by the book. So anyway, Bitcoin to me, I don't know whether it was part of Satoshi's genius to limit Bitcoin mintage to 21 million units, but that created an artificial scarcity. I would say you could calculate a value for Bitcoin based on its usefulness in affecting secure transactions and recording them, even though nobody really does transactions in Bitcoin. Almost nobody. So if you take that as a value, a true value of Bitcoin, then you could say Bitcoin's worth maybe $2 or $3 per copy, but certainly not $123,000 per copy. So I think Bitcoin will come to naught, and it's still, the model is still there for the U.S. to return to a time when we had local currencies, and I've heard Bitcoin sort of described as a logical successor or a medium that could replicate the money system that existed in the U.S. in the late 1800s, where people would park their gold in a bank and they would get receipts for it, and those receipts circulated as currency. And people will say, well, in the same way, a little town, a city, a village, I don't know if we have villages anymore, if that haven't been discovered and subdivided, but in any case, a town could establish its own money system. And if miners came there and parked real assets in a vault, like bullion in particular, the receipts could circulate as local money, and without any regulators coming down to check it out, the receipts would establish their own credibility as currency. The only problem doing that with Bitcoin is there's nothing there. There's nothing deposited in the bank that stands as a store of value against which these receipts are issued, these receipts that become money. So I think that even though it's a quaint an appealing idea that every town we should all have the ability to create money. It can't really happen with Bitcoin.
Well, when you talked about each little municipality having their own currency, isn't that what happened to the Weimar Republic in Germany? Every company was allowed to print out their own money to pay their employees, and that led to rampant inflation where you needed billions of marks to buy a loaf of bread.
Well, I see. I don't know. It seems like other of your interviewees has read Ferguson's book, which is the only book out there at the time it was written that described what actually happened in Germany. But no, those weren't local currencies; those were D-marks. And the reason the Weimar government authorized the creation, Germany was a union town after World War I. And the thing they feared most wasn't so much war reparation payments or anything else. It was just the problem of making payroll because, in the post-war period, all the Allies, ironically, had great economic difficulties. The Britain and France really struggled in the period from 1918 into the early 20s and beyond. But Germany, paradoxically, was at close to full employment. And so the German government was so dedicated to the project of keeping employment close to 100% that it made certain that the payroll, that the workers got paid every Friday. And as the German the German government authorized some of the larger manufacturers to print their own scrip. If the boxcar full of D-marks did not show up on a given Friday, and the German hyperinflation, it really took place over, I think it was April of 1921 into 1923. It was a fairly short-lived, but it was definitely not an experiment in local currency creation. And if you chart out the D-mark's value in that hyperinflation, the periods where the inflation spiked corresponded to, I think it was 2 intervals over the period of about 18 months, where the German money printing presses literally broke down. They were having to print quadrillions of D-marks toward the end, and just getting all that paper out would tax the machinery. So that's when the employers, the larger German employers, created very liberal sums of payroll money. And it's still an open question as to whether that would happen in the U.S. I tend to doubt it, but the example would be, we all know one thing for certain, that when the economic system collapses, the state of Illinois will be first. They are the most profligate, corrupt spenders of all 50 states, and I don't take that lightly because I came from New Jersey myself, which, along with Louisiana, they're probably in the top 5 of corrupt, free-spending states, where pretty much all the money is purposed on some sort of corrupt scheme. So, all right, so Illinois is going to be the first to go over the falls. We know that. And there are probably 24 states that would follow closely behind. But if the government pulls a Weimar Germany and says there's this editorial outcry for the U.S. government to bail out Illinois, well, I always tell my subscribers to substitute the word taxpayer for government in sentences like that. So the taxpayer, all working taxpayers of the United States will bail out Illinois. And the problem there is, it's not like you're inflating financial assets, which that's a trick we've mastered. It's no difficulty inflating home values and stock prices and things. But to try to inflate an imploding pension system is a whole different project, because the money that gets shot into it to create the inflation, it's actually spent each month by the X millions of retired Illinois workers who, every month they get their check for, let's say it averages $1,700. That's real money that the rest of us would have to contribute into Illinois. So you can see that that's not going to go on very long. And when the 24 other states come with their arms stretched, their hands out for, where's ours, then you're faced with the decision, well, if the government, quote unquote, if taxpayers bail out, well, forget it. Taxpayers don't have enough money to bail out the 24 states. But if we do it by way of printing press money, then within 6 to 8 weeks, we're going to have a hyperinflation where the $1,800 check that the Illinois pension recipient gets, it won't buy a basket of groceries. So that means of a bailout is self-destructive. So I know we're sort of off on a tangent, but you mentioned Weimar Germany, and I think that the lessons of that are very clear for any attempt the U.S. would make to try to inflate its way out of the coming collapse, which, again, it's going to happen in Illinois if you want to just know where to focus your attention.
Rick, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. I think I was kind of winging it today to put things out there that we don't talk about a lot, but we're getting closer and closer to the day when it'll all matter.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Coming up, Robert Campbell, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money.
Thanks for inviting me again, Jim.
When's the next issue of the Timing Letter coming out, and where can our listeners subscribe?
The last issue came out on July 15th. That was a month ago, and the next issue will come out in September 15th, next month. I publish once every 2 months.
Based on your book, Timing the Real Estate Market, what are current indicators predicting?
They are predicting that we are slowly, steadily moving toward the pinnacle of the current real estate cycle. We're not there quite yet. We're getting very close. 35% of all major cities in the United States are experience year-over-year price declines, about a month ago with the latest reporting, but that means 65% are still going up. So on balance, the country in general is still rising, although the rate of appreciation, the year-over-year rate of appreciation keeps getting slower and slower and slower, but it's been a slow process.
Gold's been trending sideways since April. Do you think the U.S. could see the return of the gold standard?
The U.S. Treasury, the U.S. government is $37 trillion in debt. That's the national debt, and there's no way that can ever be paid back in real dollars. No way. I mean, if you take every person in the United States, everybody, even including from 80-year-olds to 1-year-old babies, I think we all owe on balance over $100,000. And there's no way that can be paid off, No way. It's just way too much. So ultimately it's going to be defaulted on in some way, either through inflation, or they'll just say, hey, flat out, we can't afford to pay it, and we're not going to pay it. Or what they will probably do, what I think, and I've been thinking about this for over 20 years now, is they're going to revalue gold to a big number, 25,000, 50,000, whatever it takes, and they can do that. They can do that overnight, and all of a sudden back the U.S. dollar with 30% gold to bring confidence in the bond market so it won't collapse, so that people will still own the bonds. Otherwise, it'll get to the point where when you're faced with a default or just a default that like that will just that there'll be try to be a mass exit out of the market. Interest rates will go from on 5-year, 30-year treasuries would go from 5%, to 20% to 30%, whatever the case may be, and that would collapse the whole economic system. So I think they're going to use gold to back the currency at an inflated price, just like they did in I think it was 1931, the early 1930s, when they revalued gold from $20 an ounce to 35. So I think they're going to do something similar, but it's going to be a much bigger revaluation of gold to pull it off when you owe $37 trillion.
Do you think the U.S. government secretly is piling up gold like China, India, and Russia have been doing the last dozen years?
Well, China and Russia, there's been no secret about it, as well as other countries, Jim. The U.S., they're silent on it, so I have no idea. I mean, there's a lot of speculation that we don't have any gold. I mean, Trump came to office, and one of the things that came out, he said, "Hey, we're gonna audit Fort Knox," and everybody was gung ho about that. Yeah, why not? We need to verify that we have 8,000 pounds of gold. Well, that audit's never happened. So why, I have no idea. But there's been no confirmation that we have that gold.
Would you like to take a trip to Fort Knox to see if it's there, not just a bunch of gold-plated, titanium?
Well, and do the testing on 8,000 bars?
Yeah.
Not really.
Yeah.
Only because, and this, I mean, that you have to be real careful with that, Jim, because all of a sudden they can ship thousands of tons of gold into Fort Knox that's borrowed from other countries, borrowed from other sources, and bring it in and say, "Hey, there it is, guys. I mean, there it is, guys. Count it, test it, do whatever you want. Yep, there's 8,000 pounds there of gold, sure." And then after you leave, they'll ship it back to the country it came from. So it's real. I mean, you can play a lot of games with gold like that. You'd have to verify that you actually own it, because a lot of countries, foreign countries, they store their gold in New York in the New York Federal Reserve. That's not our gold; that's their gold. And interestingly, they're asking for it back right now in record numbers. So gold is in play, guys, and I think it's going to be the new world reserve currency, one way or another.
Now, when Germany asked for their gold back from the U.S. where it had been stored, it really was, heavy metals, just gold-plated, and they tested it and found out it wasn't 100% real gold.
That recently?
That was several years ago.
So it wasn't even real gold. So what'd they do with the real gold?
Well, exactly. And Germany insisted we would like our gold bars to be 100, whatever it is, 99.9% pure gold, not and not gold-plated tungsten, which weighs about the same amount.
Right, exactly. I mean, so you can play a lot of tricks with that stuff. In my mind, that everybody should own gold, but they should own gold, physical gold that they have in their hand, not gold ETFs like GLD, or not have it in a depository where somebody stores it for you and takes care of it for you, or you don't keep it in a bank or anything like that. You have it in your own hands, so that stories like you just illustrated from Germany don't happen. I hadn't heard that story, Jim.
Well, of course not. They don't want you to know.
Yeah, exactly.
What's the latest on real estate across the U.S.?
Well, as I mentioned earlier, that there are more cities where homes are appreciating than depreciating by a factor of 2 to 1, even though the rates of price appreciation are very low. They're in the 2% range, whereas a year ago they were in the 6% range or thereabouts. I mean, there's some exceptions to that rule where the northeast part of the United States, places like New Jersey and Boston and Connecticut and up there are still doing really well, and they're appreciating in double digits. But also there's some cities, like in Texas, for example, that Austin, Texas, that's one of the worst housing markets in the country. That's depreciating at double digits on the downside. But on balance, things are still going up.
Any idea why Austin is doing so poorly?
Not really. I mean, they had one thing. They had a huge run up. All of a sudden, everybody was leaving California and moving to Austin, and they did that. I mean, in Austin, housing prices, that outperformed almost every other place in the United States by quite a large margin. And the old expression, the bigger the boom, the bigger the bust, generally holds true, and that's what you're seeing right now. Everything reverts back to normal. And it's in the process of reverting back to normal. So a lot of those gains are going to end up getting eaten up. And I haven't done any exact analysis, downside analysis on Austin, but it wouldn't surprise me if Austin housing prices during this cycle, fall, 50-60% from the peak to get back to what quote unquote normal.
If the price of your home is falling and you just plan to live there, for maybe not the rest of your life, but for a substantial period of time, should you worry about it?
Well, I don't know about worry about it is the right term. I guess that depends where you are at what stage of your life. I mean, that to me, we all need a place to live. Whether we rent our place or own our own home, we have a place to live. But if you're fortunate enough that you bought a home at a good price, a long time ago, like 20 years ago, and you can still afford to stay there, stay there. Then you can take the long view of real estate because you need a place to stay. But in other situations, let's say that you are nearing retirement, and the average retiree in the United States, 60% of his net worth is in his home, and he's counting on selling his home at age 65 or 70, and in downsizing and using the excess proceeds to fund his retirement, then you got a problem. Because now all of a sudden, you're not, freeing up, $200,000 or $300,000 or $400,000. Now you're freeing up half that much, and if you're going to live another 15 years, that amount of money isn't going to cut it. So it's always a dance how you play it. So housing prices go up and down. And what a lot of people here in California have been doing the last 10 years, because a lot of my timing letter subscribers are in the real estate business, and I say, okay, 10 years ago, if somebody in San Diego sold their home, what do most of them do? They're moving up. They buy a better house. In the last, prior to 10 years ago, in the last 10 years, 90% of them aren't buying a bigger house, a more expensive house. They're moving out of state. They're moving to Texas. They're moving to Arizona. And why are they doing that? They're selling their house in San Diego. I think the median price right now is $1 million, and they're selling it for $1 million. And all of a sudden, they're taking the cash and moving to Arizona or Texas and buying that same home for $400,000 or $500,000, and now they have $500,000 to live on. That makes sense. So if the houses in Texas and Arizona go down, at least they still have $500,000 to live on. That makes a lot of sense. But it's always a lot depends on your net worth, how long you're going to work, how secure you are in your job, a lot of things like that. But playing the cycles and understanding the cycles is really, really important. And understanding those cycles, because the vast majority of the time that how you play the cycles is going to be a big determinant how well or how poorly you do financially during your lifetime.
What's the latest on California real estate?
California real estate's still hanging in there. We're doing okay. I mean, our rate of annual, year-over-year annual rate of appreciation has gone down a lot in the last year, but it's still positive. I mean, the worst housing market is up in San Francisco. San Francisco, the whole area up near the Bay Area. However, on the other hand, when you just go 50 miles south of San Francisco City, you're in San Jose, Sunnyvale. That's the highest price. That's probably that housing market is still performing really well. Like in Silicon Valley, I think the median price home there is I think it's risen to $1.9 million. That's median price home. You get to live in San Jose for $1.9 million. And I don't know how to explain that. Those people up there are making a lot in Silicon Valley are still making a lot of money. Those high-tech people, the Facebook guys, they're all making a lot of money. But for some guy new to come in and plunk down have a big enough income and a big enough down payment to afford a $1.9 million house, it's unbelievable the amount of cash and income they need. And interestingly, speaking of California, because this is where I grew up and and where I've lived my whole life, in San Diego, the age of the first-time home buyer in California is 49 years. 49 years, guys. And you wonder why all the young kids are depressed? There's a big reason. I know that when I was growing up here as a kid out of college, totally different situation. Totally different situation. When I graduated from UCLA, I joined the Air Force to be a pilot. I didn't go out and get a job, but if I did go out and get a job, I could have got a job for $13,000-$14,000 a year. I could have bought a home in Encinitas, which is right on the beach, half a mile from the ocean, which is where I grew up. It would have been a modest home, 3-bedroom, 1 bath, the kind of homes my dad built after the Second World War, 1,000 square feet, 1-car garage. I could have bought that home for $60,000 right out of college. Today, that home is worth around $2 million. That's how hard it is for today's kids. If I was, by the time I always wanted to get ahead in life, and that I've always been around building and construction and development, so I use that as my vehicle, to make money and get ahead in life. And but if I was 18 years old today, and all of a sudden saying, okay, here's the and with my family and real estate the way it is, I wouldn't stay in San Diego. I wouldn't stay in California. I don't know where I'd move. I might even move to someplace like Detroit, where you can buy a house for $5,000. Put in some sweat labor and use your brains, and all of a sudden, make some improvements to it. Rent the house out for $700 a month or something like that, with a positive cash flow of $700 a month, $500 a month. Sell the house and make a $20,000-$30,000 it, and start building my net worth that way. Because you're sure not going to do it in Encinitas the way. By the time I was 30 years old, I owned 13 rental properties in Encinitas. 13. I mean, and all the money, I earned it all myself and did it and was able to. No way you can do that today. Most people can't even own one house today, let alone 13. So my advice to young people that want to get ahead and do it in real estate, get out of California. I mean, get out of California. Just go someplace where it's cheap, and then use your brains and, buy something that nobody wants, put some, add value to it, rent it out, and all of a sudden you go, wow, $700 a month positive cash flow? That's pretty good in today's market. Yeah, that house is sure worth more than the $13,000 that, you have into it, $10,000 plus $3,000 in fix up. You might be able to sell it for double that. Now you just made yourself, $13,000 or whatever. And you can repeat that, and pretty soon you've got yourself, $250,000 and just keep moving from there. But you're not going to do it in California anymore.
Are building inventories and slower sales usually instrumental in market downturns?
Absolutely. And all you got to do is look back in time. And that's what allowed me to write my book, Time in the Real Estate Market, where I identified, these key variables that are closely correlated with price movement of homes. And you look back that when home sales are going down, trending down, housing prices go down. When supply is going up, home prices are going down, and vice versa. So they're very, very well correlated, and that's why it's fairly easy to do what I do now that you know what to look for. I don't have to spend my time listening to the 35-year-old experts that have made a lot of money in real estate because we've been in a bull market. All of a sudden, because pretty soon there's going to be a down market. Now you see how you perform. But so you just watch these certain variables. It's much, much easier than the stock market to gauge the up and down, the cycles. And that's why I like it the best. And that's where, I've made probably at least 70% of my net worth is from, being successful in real estate.
The stock markets are continuing to hit new all-time highs. Can the stock market strength be good for real estate?
Yeah, it's certainly not bad, that's for sure, because all of a sudden, okay, let's say, especially if you're nearing retirement. Let's say you're nearing retirement, and you go, okay, look, I've got $1 million in my 401k right now, and the stock market's hitting all-time highs, and all of a sudden the stock market, takes a downturn and falls 40%. Now you've only got $600,000. Okay, is $600,000 going to cut it? I don't know. I mean, it may not. And if it's not, all of a sudden, what's your other asset? Housing, your house. You've got 60. That's the 60% of your net worth. You might consider selling your house, and with more people selling their house than wanting to buy houses, that'll depress prices. So I think there is a relationship there between the stock market and real estate that's well correlated, even though the stock market isn't a good timing device as far as when to buy and when to sell real estate.
Do you think President Trump will get the low interest rates he wants, and would mortgage rates likely move with the Fed?
I think we're going to get, it depends. And I know that's, and I rarely use that as an answer, but the prior to 2 months ago, I was to say the Fed's going to cut interest rates based on some key indicators that I follow. They're going to cut interest rates. They're cutting interest rates, all over the world. The Fed hasn't cut interest rates in quite a while. They're going to cut interest rates. Why I'm hesitant to say that is that inflation and the producer price index in the last 2 months have started trending back up, come up, 2 or 3 straight months in a row. That's a very bad sign. Right now, they're both, I think the consumer price index is at 3%. I know the Fed likes the number 2. I mean, how realistic that is, but it's not at 2. And so you don't cut interest rates if you're trying to get inflation from 3% to 2%. You raise interest rates, which isn't going to happen. So I'm a wait and see on that.
What's the difference in thinking in terms of cycles versus linear?
That is such a great question, and I'm glad you asked it. Most people live in a linear world. They take the long view of everything. If you bought a home 50 years ago, look where you are today. Or you listen to the National Association of Realtors, or the California Association of Realtors, or the Mortgage Brokers Association of America. When's the best time to buy a home? It was always yesterday. What they don't realize, and that I have studied and know to be a fact, is we don't live in a linear world, guys. We live in a cyclical world. Things go up, things go down. Things go up, things go down. So depending on when you buy and when you sell, that can make a huge difference. For example, people in a linear world say the best time to buy real estate was yesterday. Okay, if you bought real estate, let's say, in the last future is going to look like as far as, price appreciation? You're going to get creamed. You're going to get creamed. And this real estate boom in California and the United States was bigger than the last real estate boom. And if you adjust for inflation, which you should do, one, it identifies the cycles more closely, because most price appreciation is inflation. It's like 80% inflation. It's not like it was based on anything real. It's just everything's going up. But if you look at the cycles going back, you can see that things go up and things go down. So, and in fact, in California, if you bought real estate back in 2005, which was the peak of the market, or 2006, I should say. Let's go with 2006. If you adjust those housing prices for inflation, we're still not back to break even, guys. Nationally, we're a little bit above it. So when you buy makes a big difference. You can't go sideways for 20 years and get ahead financially. So we live in a cyclical world. So even if you use the cycles, like my work in real estate, to pay attention to them, even if it helps you avoid the big disasters, even if it helps you buy at a price that's very favorable. It doesn't have to be at the exact bottom, but when prices are depressed. And then if you need to sell for retirement or what other reason to send your kids to college or whatever, if you sell at or near the top instead of writing it back down, you've been far more successful than most people that take the linear view that with respect to real estate, that it always goes up, because it doesn't go up. Most people do have a timing strategy when it comes to real estate. Definitely. It's kind of unspoken, but here it is. They buy real estate when they have the money. Most people think everybody gets rich, from real estate. No, that's not true. It's not even close to being true. So you have to look at the cycles. Yes, play the long view. I mean, will real estate come back? Yes. How long is it going to take to come back? Is it going to take 20 years to come back? I mean, we don't know. But if it takes like 15 or 10, or maybe it's going to take 25 this time. If you're sitting there with an overpriced house thinking, okay, in 10 years I'm going to retire, and then I'm going to sell my house and retire in comfort and start, sailing the Greek islands, all of a sudden your net worth on a real inflation-adjusted basis could be down 50%. You aren't sailing anywhere. But you got to pay. We live in a cyclical world. Adjust to the cyclical world, even though in the long run, at least so far, everything's going to go up in value.
Is having real estate wisdom important in identifying cycles?
Absolutely. I mean, I was born, one of the advantages I have over most people is that my dad was a builder-developer for his whole life. That he came back from World War II. He was a Marine. He fought on Okinawa, got a Purple Heart, came back, and I was born in Tacoma, Washington. And Dad started building houses. We lived there for years. And Dad said, screw this. I'm not going to keep building houses in the rain. So he moved our family to San Diego. And that's what he did. And so from the time I'm a little kid, I've known about real estate. I've been through the cycles, the good times, the bad times. And that's the advantage of getting older, guys. As a 35-year-old, even though that I consider myself smarter than your average bear, at 35 years old, you don't know anything yet. You haven't seen anything. That, life will beat you up. So I've seen the ups and the downs, and that's what allows me to to write a timing letter that I've written for the last 23 years. To have and meet a lot of really good people that have stayed with me for 23 years and give them good advice over that 23 years, because I'm wise. I'm not just smart. Until you experience something, you don't know it, guys. I don't care. You all of a sudden you go, oh, I'm cum laude, out of college, blah blah blah. I'm one real smart daddy-o. Yeah. So what? College grades are very, very loosely correlated with success. It's all about experience. And
how important is health in life?
Health first, everything else is secondary. It's that simple, guys. Everything else is secondary. First thing I do when I get up in the morning, and I've done this for the last, almost the last 30 years. Prior to age 50, I didn't have to do it. I mean, did I work out a lot? Yeah. I wasn't a member of a gym, but everything else is secondary. You got to work out. You got to go to a gym. You have to lift weights. Talking about guys. That's what keeps you strong. That's what keeps your muscles strong. That's what keeps your brain strong. And if there's one exercise that I focus on more than any other, it's your legs. And what I do is I do plie squats. Do them. I go to the gym once every 2 days, and do about 7 or 8 exercises. I mean, I don't lift the weights I used to, but I'm certainly I don't lift with the girls, that's for sure. I lift way more than most people my age, but these squats I do, it's a body weight. I just spread my feet, my shoulder length apart, put my hands behind my head, and then squat down, keep my body as erect as possible, and that just go up and down, up and down, up and down. Because what that works is that works your core, which is your glutes, which is the most important body and the muscle in your body. Because that's what gives you stability, guys. That's what allows you to stay strong on the ground. You got to do those kind of squats, and that's my favorite exercise. And that'll keep you strong, so you don't start falling on the ground and breaking a hip or an arm or ribs or something like that. Because then as you get older, that gets curtained. But absolutely, health first. Everything else is secondary.
Robert, again, where can people follow you, buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
You can go to realestatetiming.com. And even if you don't subscribe to my timing letter, you can, I have a blog that I write things on infrequently, but it's all good stuff. I write about real estate cycles. I write about real estate. I write about health. And I write about other things that I've learned, like that. Because it's just not about making money anymore, guys. I mean, but it's all those things. Sign up for my blog, and you can see how I think, and maybe if becoming buying at a better price and selling at a better price in real estate, maybe you'll subscribe.
Robert, thanks again for being on This Week in Money.
Welcome, Jim.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Victor Adair, Rick Ackerman, Robert Campbell, and thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.